Imagine waking up one day and finding out the US dollar is no longer just paper backed by trust, but once again tied to the ancient power of gold. What would that mean for your savings? For global power? For America itself? Because here's the shocking truth: behind closed doors, powerful voices are whispering about gold. Some US states are already preparing for it. Countries like China and Russia are stockpiling it. And economists warned us. They're warning that the world is shifting fast. But could the United States really go back to the gold standard? And more importantly, should it? In this video, we dive deep into a question that's been gaining heat, but is barely discussed on the mainstream stage. We're peeling back layers of history, power, and economic strategy to explore whether the US dollar could ever be backed by gold again. It's a question loaded with implications. The moment you understand the gold standard and why America left it, you'll see the global economy in a whole new light. You'll uncover why some believe returning to gold would restore discipline and others think it would collapse everything we've built. He's warned that we're witnessing a long-term debt cycle unfolding. According to him, this is the kind of environment where the world begins to question fiat money and looks for something real, something like gold. He has pointed out that every empire in history, from Rome to Britain, has faced a moment where its currency weakens, its debt piles up, and its global influence starts to shake. When that happens, people stop trusting printed money. They seek assets that can't be created out of thin air. Gold. But we're not talking about fairy tales or financial fantasy. The gold standard isn't just history. It was the foundation of the US economy for over a century. In fact, for many years, every dollar printed had to be backed by a specific amount of gold. You could actually exchange your paper note for physical gold at a bank. That's not fiction, that was reality until 1971. So what changed? Why did the US, the most powerful economy in the world, abandon gold? And if it worked for decades, why hasn't it come back? In this video, we'll take you through that forgotten chapter of US history. We'll look at why President Nixon made the fateful decision to cut the tie between the dollar and gold. We'll uncover how that unleashed a wave of inflation, debt, and new global dominance all at once. We'll explore how the US created what economists call fiat currency, money that holds value simply because people believe in the government issuing it. And here's where it gets interesting. Even though gold was pushed out of the official system, it never disappeared. In fact, central banks around the world, including the Federal Reserve, still hold massive amounts of gold. Why? If gold is obsolete, why are the world's most powerful institutions still clinging to it? He believes gold is far from dead. He's gone on record saying gold should make up at least 10% of a well-diversified portfolio. Why? Because in moments of crisis like war, inflation, or political instability, gold doesn't just survive, it thrives. And right now, the world is shaking. Wars, supply chain chaos, interest rate shocks, debt ceilings, global rivalries. The US dollar still reigns, but for how long? Countries like China and Russia have accelerated their gold reserves in recent years. Some even conduct trade outside the dollar. Iran, Brazil, even India are all experimenting with alternative systems. These moves may seem small, but they point to one thing: a growing desire to step away from US dollar dominance. Now here's the twist. Some US states are taking their own steps. Texas has created a state-run gold depository where citizens can store their physical gold and use it for digital payments. Missouri is drafting legislation that could allow gold and silver to be used as legal tender. That's not speculation, that's happening right now. Could this be the beginning of a shift back to gold? Or is it just political theater? He sees a world in transition. He argues that when empires decline, they lose control over their currency. He believes we are at the late stage of the US cycle, not the end, but a moment that demands caution. So if the US dollar were to return to gold backing, what would it take? Would it stabilize the economy? Restore faith? Or would it tie America's hands at a time when it needs flexibility the most? We'll break down the mechanics, how much gold the U.S. actually holds, how much money is in circulation, and what it would cost to convert dollars into gold again. Spoiler alert, it's not pretty. We'll also explore whether gold-backed digital currencies could be the real future, merging the trust of hard assets with the speed of modern technology. By the end of this video, you'll understand the debate like never before. This isn't just about economics, it's about power. It's about whether America continues to shape the world economy or gets forced into a new reality by rising powers and crumbling trust. He believes change is coming, but whether that change involves gold or something else entirely depends on what happens next. So stay with us, because what you're about to learn may change the way you think about money, power, and the future. Welcome to Economic Reframe, where we break down the forces shaping our financial world. If you're ready to challenge what you thought you knew, hit that subscribe button, and let's dive in. There was a time when every US dollar had something solid behind it. Gold? Not just as a symbol, but as a guarantee. If you held a dollar bill in the late 1800s or early 1900s, you held a promise. You could walk into a bank and trade it for gold. No questions asked. This system was known as the gold standard. It wasn't just about shiny metal. It was about trust, about discipline, about making sure the government couldn't just print endless amounts of money, because every dollar had to be backed by something real. The U.S. had to manage its money supply carefully. The Gold Standard Act of 1900 made it official. The U.S. defined the dollar as a fixed amount of gold, roughly 23.22 grains. Gold became the anchor of the American economy. Trade agreements, debt payments, savings, investments, everything operated under the logic of gold. And it worked, for a while. It gave the world stability. People trusted that the value of their money wouldn't just vanish overnight. Inflation was controlled. Governments couldn't easily overspend. And it wasn't just the U.S. Many of the world's biggest economies operated under similar gold standards, creating a global system tied together by a precious metal buried in vaults. But cracks started to show. World War I changed everything. Nations needed more money fast, and the gold standard didn't like fast. It demanded patience, balance, and restraint. So one by one, countries suspended their gold ties to pay for the war. The U.S. returned to gold in the 1920s, but the damage was done. The world was different now. Economies were bigger, global trade was more complex, and gold couldn't keep up. Then came the Great Depression. Banks failed, unemployment soared, the U.S. needed bold action. But the gold standard was like a tight belt. There was no room to breathe, to spend more, to create jobs, to rebuild confidence. The country needed to print money, but gold wouldn't allow it. In 1933, everything changed. The government made it illegal for citizens to own most forms of gold. The next year, the Gold Reserve Act of 1934 gave the U.S. Treasury control over all gold and raised its price from $20.67 to $35 an ounce. This gave the government more money on paper without mining a single ounce more. It wasn't a full break from gold, but it was a major shift. The gold window remained open internationally. Other nations could still convert dollars into gold through central banks, but for ordinary Americans, the connection between their cash and gold was gone. The final break came decades later during another time of crisis. In the late 1960s and early 70s, inflation rose. The U.S. was spending heavily on the Vietnam War and social programs. More dollars were being printed, but gold reserves weren't growing. Other countries noticed. They started demanding gold for their dollars. It was a run on the gold supply, and the U.S. was at risk of losing the very foundation of its financial system. In August 1971, President Richard Nixon took the ultimate step. He closed the gold window. No more gold for dollars, not for Americans, not for foreign governments. The dollar was no longer tied to gold in any form. It was the birth of the fiat era. Now the dollar had value because the U.S. government said it did, because the Federal Reserve backed it, because markets trusted it, not because it could be traded for gold, but because people believed in the strength of the American economy. This was a turning point, not just for the U.S., but for the world. Today's global financial system is built on fiat currency, not just the dollar, but the euro, the yen, the pound. They're all fiat. They exist in a world where money is based on trust, not metal. And yet, the dollar leads them all. Why? Because the United States built an empire of trust. Its economy became the largest, its markets the deepest, its military the strongest. The world began trading oil in dollars. Countries held dollars in reserves. The dollar became the default currency of the planet. Without gold. But there's a catch. Fiat currency gives flexibility. In times of crisis, the U.S. can print money, it can issue stimulus, it can lower interest rates, it can move quickly, unlike the gold-bound system of the past. But with that power comes risk. Too much printing can lead to inflation. Too much debt can shake confidence. And when trust begins to crack, people start looking for something real, something ancient, something you can hold in your hand. Gold. That's why gold never truly disappeared. Even though it's no longer backing the dollar, it still sits in the vaults of central banks, still moves markets, still represents a fallback when the world seems uncertain. It's also why gold prices tend to surge during times of global instability. War, inflation, banking crises, they all send gold higher. Not because it's a perfect solution, but because it's simple. Gold doesn't require trust, it just exists. Still, the dollar has survived decades without gold. In fact, it's thrived. The U.S. has built a financial system so powerful that its currency is used in countries far beyond its borders. That kind of reach doesn't come from gold. It comes from influence, reliability, and reputation. So while gold remains part of the conversation, it's no longer the main character. The modern system favors speed, control, and adaptability, and fiat currency gives the U.S. tools that gold simply can't. When markets crash, central banks can react instantly. When pandemics hit, governments can fund recovery. When wars break out, they can support defense without emptying gold reserves. But trust remains the invisible gold. As long as the world believes in the dollar, it works. The moment that belief fades, everything changes. That's why voices continue to warn that the era of unquestioned dollar dominance may not last forever, that the rise of debt, the erosion of purchasing power, and the printing of trillions could bring new challenges. Some argue for a return to sound money. Others suggest a digital currency backed by commodities like gold. The conversation is growing, but the reality is complex. A return to the gold standard would mean massive shifts. It would restrict spending. It would force deflation. It would likely trigger economic pain before any benefits appeared. Yet the longing for stability still drives the gold conversation. And in a world where trust can vanish in a headline, the question remains: can a currency truly stay strong forever without anything real behind it? Gold may be a timeless symbol of wealth, but in today's world, it's simply too small to carry the weight of the modern U.S. economy. At first glance, backing the dollar with gold might sound like a return to discipline, a way to stop reckless spending, limit inflation, and restore trust. But the numbers tell a very different story. The United States holds around 261 million troy ounces of gold in reserve. At today's market prices, that's worth roughly $550 billion. But here's the problem. America's money supply, specifically the broad M2 measure, is more than $20 trillion. That means U.S. gold reserves barely cover 2.5% of the dollars in circulation. If we were to back every dollar with gold again, either the dollar would have to be drastically reduced in volume, or gold would need to be revalued to astronomical levels. That kind of revaluation would break the financial system. It would cause massive distortions in prices, wipe out existing contracts, and plunge the global economy into chaos. You can't simply snap your fingers and return to the gold standard. The entire structure of modern finance isn't built for it anymore. That's because today's economy runs on liquidity. It thrives on speed, credit, and the ability to respond quickly. Governments need flexibility to inject stimulus during crises, support banking systems, or fight inflation. Gold, by contrast, is rigid. It doesn't grow with the economy. It doesn't move with demand. It just sits in vaults. This is why the world moved away from gold in the first place. Returning to it would mean surrendering key tools like interest rate adjustments and money supply management that modern economies rely on. It would also mean giving up the ability to run deficits during recessions. That's not discipline, it's economic paralysis. Meanwhile, the US dollar continues to enjoy a unique global status. It's not just America's currency, it's the world's currency. Roughly 60% of global foreign exchange reserves are held in dollars. Nearly 90% of global trade transactions involve the dollar in some form. Commodities like oil, wheat, and metals are priced in dollars. This gives the US an enormous advantage. Economists call it exorbitant privilege. It means the US can borrow more cheaply than other countries. It can run larger deficits without crashing investor confidence. It can export inflation and import capital. The world needs dollars, so it keeps buying US Treasury bonds, keeping demand high and interest rates low. This system gives the US unmatched financial power. It helps fund defense. It supports infrastructure. It sustains entitlement programs. It allows the US to act fast in crises without worrying about draining its gold vaults. Gold can't offer that privilege. Only trust in the dollar can. Of course, gold still plays a role in the global system, but not as an anchor. It's a hedge, a backup, a form of protection. Central banks around the world have been quietly increasing their gold holdings in recent years. Why? Because in a world of geopolitical tension, rising inflation, and growing debt, gold provides security. It's not about replacing the dollar. It's about diversifying reserves. Even within the US, some institutions are buying gold as a precaution, not because they expect a return to the gold standard, but because gold tends to hold value when everything else is falling apart. It doesn't pay interest, it doesn't generate income, but it doesn't default either. It's immune to political games, central bank policy, or credit ratings. This behavior isn't limited to governments. Investors do it too. When markets panic, when wars erupt, when inflation spikes, gold rises. That's not a coincidence. That's fear protection. It's emotional insurance in a volatile world. But it's not a system. It's not a solution. No serious economy is trying to rebuild itself on gold. Not China, not Russia, not the EU, not even the countries that complain most about US dollar dominance. Because no matter how much they talk about de-dollarization, they still trade in dollars, they still save in dollars, they still borrow in dollars. That's because, despite its flaws, the dollar offers something gold never will: confidence in scale. It can move billions with a keystroke. It connects global banks, institutions, corporations, and consumers. It's embedded in systems that stretch from New York to Nairobi, from Tokyo to Rio. Gold may glitter, but it doesn't flow. He has long spoken about diversification, and gold has its place within that. But he's never argued that it should return as the sole foundation of the economy. Because he understands what many don't. We are no longer in a world where currency needs to be tied to a fixed commodity. We're in a world that runs on complexity, velocity, and leverage. And in that world, the dollar, imperfect as it is, still dominates. Calls to return to gold may come from a desire for stability, a longing for order, or frustration with inflation. But gold can't solve those problems anymore, not without unraveling everything we've built, not without triggering a reset so disruptive it would cause more harm than good. So yes, gold is still relevant. Yes, it still holds value. Yes, smart investors and central banks will continue to own it. But it's no longer the bedrock of the American financial system. That role now belongs to the dollar and to the global trust that sustains it. While the federal government shows no intention of returning to a gold-backed currency, some U.S. states are beginning to experiment with a different path, one that reintroduces gold into everyday transactions. This isn't a revolution from Washington, but a quiet movement unfolding on the state level. It's grassroots, it's local, and it's drawing interest. Texas, for example, has already established its own state-run gold depository. The Texas Bullion Depository allows individuals, businesses, and even other states to store gold securely within Texas borders. But it doesn't stop there. Through emerging fintech platforms, citizens can use their stored gold to make payments just like a debit card. You're not handing over coins, but the value is there, backed by precious metal rather than dollars. It's digital gold, grounded in physical reality. Missouri is going even further. Lawmakers there have introduced legislation that would formally recognize gold and silver as legal tender. That means residents could, in theory, use gold to pay for goods and services without triggering state-level capital gains taxes. Other states like Utah and Wyoming have explored similar measures, slowly weaving precious metals into their legal and financial frameworks. But it's important to understand what this movement is and what it's not. These state-level efforts are not an attempt to overthrow the dollar. They're not rejecting fiat currency wholesale. Rather, they represent a push for monetary diversity, for financial sovereignty at the state level, and for hedging against what some see as federal fiscal instability. It's about giving citizens an option, a backup. Technology is playing a major role in this transformation. In the past, gold was cumbersome. You couldn't exactly buy a cup of coffee with a gold coin. But now, with digital wallets, blockchain systems, and state-run platforms, gold can be digitized, traded, and spent as easily as a dollar. This blend of ancient value and modern tech is what makes the shift possible, even appealing to a new generation. Still, this is not a national movement. Washington is not drafting laws to peg the dollar to gold. The Federal Reserve is not stocking its vaults in preparation for a hard money future. These state experiments are symbolic and strategic, but they do not yet challenge the foundational structure of the U.S. financial system. Meanwhile, on the global stage, a different kind of shift is unfolding, not toward gold, but away from dollar dependence. Countries like China, Russia, and Iran are accelerating their moves to conduct trade in currencies other than the U.S. dollar. They are buying gold, not to replace their currencies, but to reduce exposure to dollar-based sanctions and to hedge against instability in Western markets. These moves are not isolated. They are part of a broader trend known as de-dollarization. China, for instance, has been settling oil deals with Saudi Arabia in yuan. Russia is conducting trade in rubles and yuan. BRICS nations are talking about creating a new currency altogether, backed by a basket of commodities, potentially including gold. Central banks across emerging markets have increased their gold purchases year over year. The message is clear: they want alternatives. But even as these efforts grow, experts warn against reading too much into them. Kenneth Rogoff, a former chief economist at the International Monetary Fund and a Harvard professor, has pointed out that the dollar's role is deeply entrenched in the global economy. He acknowledges that the dollar may lose some of its uniqueness, but not its dominance. There are practical reasons for this. The U.S. financial markets are massive, transparent, and liquid. No other currency has a system as deep and as trusted. Alternatives like the yuan or euro lack the political freedom, legal stability, and convertibility needed to compete on the same level. And gold, while trusted, lacks the flexibility and infrastructure to serve as the backbone of global trade. So while de-dollarization is real, it is limited. It reflects geopolitical shifts, not a complete financial reset. Back home, the United States continues to operate under a fiat system, and it works. That system has allowed the U.S. to remain nimble in times of crisis. It helped the country recover from the 2008 financial collapse. It supported millions during the COVID-19 pandemic. It allows the government to inject capital, stimulate growth, and respond to emergencies without the constraints of a metal-based currency. If the dollar were tied to gold, none of that would be possible. The money supply would be frozen in place. Interest rates couldn't be adjusted freely. Every financial decision would be tied to how much gold was sitting in vaults, regardless of the needs of the moment. Economic policy would become reactionary rather than proactive. That's why even seasoned investors who appreciate gold's role in the financial ecosystem stop short of endorsing a full return to the gold standard. They understand the difference between gold as a store of value and gold as a foundation for the entire system. Gold may offer protection. It may hedge against inflation, currency devaluation, or geopolitical risk. But it can't provide the flexibility needed for an economy as dynamic and interconnected as that of the United States. The fiat system is not perfect, but it is adaptable. It allows the U.S. to respond to changes faster than any gold-based system ever could. It enables innovation in banking, digital payments, and monetary policy. It supports global commerce, diplomacy, and defense, and above all, it sustains confidence, not just in America's economy, but in its role as a global leader. So while state-level experiments in gold payments continue to evolve, and while foreign nations seek to diversify their reserves, the core of the U.S. financial system remains firm. It is not gold that backs the dollar. It is trust earned, tested, and reinforced through decades of resilience.